Good morning. This is Dylan Jovine behind the markets. Happy Monday. Today is Monday, March 30th. If there is one important lesson that I would like to impart to everybody here, it is pay attention to the bond market. The bond market is so important to our operations. And I think a lot of people don't understand just how important, because a lot of investors don't explain these kinds of things. But it's like the first thing you learned on Wall Street, or one of the first things you learn on Wall Street, is that the bond market sets interest rates even more than the Federal Reserve. The idea here is for the Federal Reserve and the bond market to be in sync. But it's often the bond market telling the Fed where rates should be rather than the Fed telling the bond market. It goes back and forth. Mortgage rates, credit card rates, car loan rates, all the rates that impact your life and consumers around the world are based on the 10-year U.S. Treasury bond. So the critical area here is 4.5%. We've seen when the yield on that goes above 4.5%, market gets crushed. When the yield starts to go below 4.5%, especially down to 4.2%, 4.1, 3.9, the market goes high. And that is because there is an inverse relationship between asset prices and interest rates. It's a seesaw relationship. When bond yields go down, bond prices and asset prices go up. When bond yields go up, asset prices go down. So that 10-year, that seesaw relationship on the 10-year is very, very important. As a matter of fact, you look at that to tell you what the market's going to do that day. That'll tell you a better predictor. It's not going to tell you for sure. Nothing tells you for sure, guaranteed 100%. But it is a better predictor of how the market's going to do on any given day or how it's going to open on any given day than anything else. And rates go up and down for lots of reasons. The bond yield has been going up now because the rise in oil is telling the bond market that's inflationary. That means over time, unless that gets under control, it's inflationary. It tends to come back down when Trump does all his disassembling, which is he confounds his opponents. He's so good at that. Saying this, talking it up, talking it down, talking something up, talking something down. That is part of his strategy. The strategic ambiguity is obviously a big part of this man's strategy. And his opponents really still haven't figured that out, at least domestically, but whatever. So basically, the bond market, though, is more in charge of what Trump is doing. He talks peace when it hits 4.5%, that 10-year yield. He talks war when it goes down. And it's very much like the Liberation Day things. He paused tariffs last year when the 10-year yield hit 4.6%. That's the bottom line. He delayed strikes on Iran when that 10-year yield hit 4.5%. Right there, we're starting to crack above that end. He further delayed strikes on Iran when it hit 4.45. So that 4.5 ceiling there, it's like the bond market is his boss. And again, I referenced this the other day. Jim Carville, a former political consultant to Bill Clinton, said, I wish I could die and come back as the bond market because the bond market's in charge of everything. My point, all of this to bring up to you, here's my point. Here's my big point. The bond market's very important. It sets our interest rates. It sets where the stock market is going. When interest rates are going down, bond market 10 years is going down, stocks go up. When 10 years going up, stocks go down. Again, that seesaw relationship between yields and asset prices. Here's the problem. The bond market has been freezing up. And this is coming out real backhand, real Wall Street insider sources. Really drying up. What's happening is buyers and sellers have been frozen since this war started, and they're not making any moves. Now, on a normal day, if you have $2 billion or $3 billion of U.S. Treasuries to sell, you sell it, and it's a very liquid market. People absorb it. I got $2 billion of Treasuries to sell. I put it out there for sale. It gets cleaned up real quick. But now I got $2 billion. It's dried up. The buyers have run away, meaning that it has dried up completely. And what that means is that any selling of something or buying of something creates excess volatility. It makes it look a lot more volatile than before. This is what we call part of the plumbing of the system. Now, when you get those volatility spikes, if there's nobody to buy it at any price that's reasonable, and I try to sell it, You get those volatility. You've seen these yields spike higher. Remember, bond prices go lower, yields spike higher. If I come in to sell bonds, it's going to go lower and the yields are going to go spike higher. What's been happening is the Federal Reserve has gone in there and acts as a buyer, but it's gotten so difficult in the past week or so, and you're going to see this come out soon unless they resolve this before that happens, is that basically traders, bond traders, I heard this from a friend of mine on Wall Street, basically they're struggling to price these things and they're actually turning off their trading machines and they're forcing their counterparties, people who want to buy or sell, to do manual trading, human to human, old-fashioned trading. Isn't that interesting? Isn't that interesting? So we've got to keep an eye on the bond market. Remember, ladies and gentlemen, the 10-year bond, the yield on the 10-year bond is more important to what happens in your life and the stock market than any other single number on planet Earth. It is the most important number you got to think about. So let's keep an eye on this very important thing, because without liquidity, the problems that we're starting to hear come from bond dealers. Without liquidity, if there's no buyer there, they're going to sell these things down and that yield has a chance of spiking, thus sending the stock market down dramatically. Remember, I told you some weeks back, right now we're risk off unless we have super special situations. And the world's not coming to an end, believe me. The sky's not falling. But we're risk off on silly things unless we are certain about them. Really super high confident. There's no certainty, but super high confident. We're risk off and we put our 4 plans practice in motion to get ready for a bigger sell-off. Anyway, that's all I have. Have a wonderful day. I will speak to you tomorrow.